Amid a strong farm economy, some bad signs. Iowa, at a time of record agricultural profits, concerns are starting to mount that American farmers could be edging toward a financial crisis. Soaring land values, increasing debt, and a strong reliance on government subsidies for ethanol production have prompted economists to warn that what some describe as a golden age of agriculture could come to a sudden, abrupt end. At risk are the livelihoods of thousands and thousands of farmers, the health of hundreds and hundreds of banks, and the vitality of an agricultural industry that has been one of the nation's few economic bright spots in recent months. We're in a very risky time, and yet we don't seem concerned about that risk nearly as much as we should be, said an agricultural economist at Kansas State University. The potential problem, researchers and economists say, is that strong demand for corn and other grains has caused prices to spiral to reach historic highs. That has led to record farmland values and steadily increasing debt as farmers borrow money to buy more land, finance the higher costs of fertilizer and seed, and upgrade their equipment. As long as the demand remains, good times for farmers should continue somewhat. But if demand falls, they could find themselves in a situation reminiscent of the early 1980s when the farm economy largely crumbled apart. Among factors that could affect demand would be a change in the federal government's policy on ethanol subsidies, now estimated at about $6 billion a year, or revisions in the Farm Bill that would lower support payments or an increase in the dollar's value, which would hurt exports. And many farm economists question whether the federal backing for ethanol will continue in the face of complaints that soaring corn prices are increasing food costs. Yes, I know. I went to the store today and a bag of Doritos went up 38 cents from yesterday. Yes, Doritos has corn in it. That's not good. Corn is used in most animal feed and is a key ingredient in many other food products. U.S. energy policy has been friendly to ethanol in the last couple of decades or years. The question is, will it continue to be? It's running up food prices, and that's causing pressure on Congress to limit mandates for ethanol usage, said Neil Harrell, a professor of economics at Iowa State University. Even at a time of such strong prices, some have noted that farmers are paying much higher prices for seed and nitrogen fertilizer, a product needed in abundance for fields repeatedly planted in corn. The increased costs and memories of the 1980s are making some hesitant to take on any more debt. I guess you could say there's an awful lot of concern in the rural communities and with some of the city people. I would think that there would be a lot of cautiousness among farmers because most of the people can remember the 80s, and I would think there's probably a lot of cautious people now on spending a lot of money. Many economists worry that farmers could be tempted to add debt due to the belief that high commodity prices will continue. Those high prices have been driven up by a strong demand for corn and soybeans from countries such as China and India, coupled with the needs of more than 50 corn-reliant ethanol plants built in the last few years. The cash price for corn from the Chicago Board of Trade has soared from $1.86 a bushel in the 2004 to 2005 marketing year to the current price of approximately $6 per bushel. That's quite an increase in just a few short years. Soybeans were at $5.88 a bushel in 2004 to 2005 and now are at around $13.50 and rising. This is not sustainable. The rise in prices is going up too fast. And as prices have climbed, so have farmland values. In Iowa, the nation's biggest corn producer, the average price per acre of farmland has increased at least 67% in just the past 5 years. That's unsustainable, very much so. Land prices are increasing dramatically, and prices of grains are high, just like the 70s, said an extension economist at Texas A&M. It concerns me a whole lot. And Harl, who has written extensively on the 1980s farm crisis, said the key is how much debt farmers take on, and it appears that amount is increasing significantly, very fast. The longer these higher commodity prices go up, the more it will draw people in to borrow heavily to buy the land, and that's when things can get dicey, Harl said. According to the U.S. Department of Agriculture, farm business debt is expected to reach $228 billion by the end of this year, at least an $8 billion increase from last year, and a new record for the 4th consecutive year. The government said much of the debt is driven by the need for new machinery, equipment, and grain storage as farmers strive to keep up with the increasing demand for grain. And the grain, or the corn for ethanol, that's crazy. It's definitely driving up the price of food. They're using the wrong things for ethanol. There's other things to use. Debt for land is expected to rise to nearly $121 billion this year, a 2.8% increase. And the USDA has said from the beginning of 2003 to the end of 2008, total farm debt will have increased by approximately $52.8 billion, or more than 30%. Recent reports filed by agricultural lenders shows the government's expectations are playing out in reality. Farm Credit Services of Mid-America, which provided $12 billion in agricultural loans for farmers in Indiana, Ohio, Tennessee, and Kentucky last year, has noted in its annual report for 2007 that high crop prices have created a much more risky and volatile agricultural economy. The group's lending was up 15.2% over the loan volume of the year before. Omaha-based Farm Credit Services of America, which serves at least 70,000 farmers in Iowa, Nebraska, South Dakota, and Wyoming, has reflected similar increases in farm lending. And Harl said the current farm economy reminds him of about 1974 or 75, several years before the boom went bust. With the price of land going as it is to the ceiling, once again, the debt load's going up. Yes, these are more signs, the last times.